Imagine a system where the very act of saving guarantees you will lose. For centuries, this impossible mathematical truth has been hidden in plain sight, engineered into the fabric of our financial world. It's a terrifying inevitability, a slow, silent thief of purchasing power, ensuring that wealth never truly rests with the diligent. Your diligent work and savings are not merely eroding, they are being actively siphoned away. Consider this. Since 1971, the US dollar has lost over 98% of its value against gold. This isn't just inflation, it's a deliberate, systematic debasement. Every fiat currency in history has returned to its intrinsic value of zero. Every single one. This isn't a theory, it's a historical law, an ironclad certainty that few dare acknowledge. We stand on the precipice of another such event, but this time the stakes are higher and the mechanism more sophisticated. This is not just a crash, it's an elite wealth transfer protocol. They call it liquidation, a clinical term for the systematic stripping of assets from the unprepared. It is a trap meticulously laid, and Bitcoin is about to be its most potent lure. The target price for Bitcoin isn't arbitrary. $12,000 is the number, and it's coming. This isn't a prediction fueled by speculation, but a chilling observation of a repeating pattern. History doesn't repeat itself exactly, but it rhymes with terrifying precision. The year 1929 offers a stark blueprint for what is unfolding now. In the decade leading up to the Great Depression, an era of unprecedented prosperity fueled by easy credit and speculative excess inflated asset prices. Everyone felt rich. Then came the contraction. The Federal Reserve, after fueling the boom, tightened monetary policy, raising interest rates and pulling liquidity from the system. This wasn't an accident. It was the deliberate pricking of a bubble meticulously executed. The result? A cascade of margin calls and forced selling. The common man, lured into the market with borrowed money, was wiped out. Their savings, their homes, their futures vanished. But for a select few, those with deep pockets and foresight, 1929 was not a disaster. It was the greatest wealth transfer in American history. They bought assets, companies, land, stocks, at pennies on the dollar, consolidating immense power and capital. It was a planned redistribution upwards. This pattern, the inflation of a bubble followed by its engineered collapse, is not unique to 1929. It is the core protocol of elite wealth accumulation. The Liquidation Protocol operates on a fundamental economic principle, the control of liquidity. When money is abundant, asset prices soar. When it's scarce, they plummet. The villain in this narrative is not a single person, but the centralized monetary system itself, particularly the Federal Reserve and other central banks. They are the liquidity spigots. For years, we witnessed unprecedented quantitative easing, record low interest rates, and trillions injected into the system. This created the largest asset bubble in history. Now, the spigots are tightening. Quantitative tightening, aggressive interest rate hikes, and a reduction in the money supply are draining the system. This creates a liquidity trap where cash becomes king, but nobody has enough of it. Businesses struggle, debt becomes unserviceable, and assets must be sold. The first to be liquidated are those with the least capital, holding the most speculative assets, often bought with leverage. Bitcoin, a highly volatile asset, fits this perfectly. This process forces a cascade of selling. As prices fall, more margin calls are triggered, forcing further sales, creating a downward spiral. It's a deleveraging event. The elite, holding vast pools of dry powder, actual cash, wait for this capitulation. They orchestrate the fear, allowing prices to collapse, then step in. They acquire these distressed assets at bargain prices, consolidating wealth and control. This is the elite wealth transfer protocol in action. The goal isn't just to make money, it's to concentrate power. By controlling the assets, they control the future. Bitcoin, once seen as an escape, becomes another tool for accumulation. The data screams this reality. According to the Bank for International Settlements, BIS 2024 annual report, global debt has reached unprecedented levels, exceeding $300 trillion. This colossal debt load is now colliding with rapidly rising interest rates. The IMF's 2024 Fiscal Monitor warns that servicing this debt will become unsustainable for many nations and corporations. The average American's savings are eroding at an alarming rate. According to the Bureau of Economic Analysis, the personal savings rate has plummeted from 25.5% in 2020 to just 3.2% in early 2024. Meanwhile, inflation, as measured by official CPI, remains stubbornly high, but shadow statistics reveal the true extent. Real inflation, calculated by methodologies used prior to 1980, is closer to 12-15%. This means your dollars are losing value at an accelerated pace, forcing you to draw down savings just to maintain your standard of living. This is the silent liquidation of the middle class. The housing market, once a bastion of wealth, shows cracks. Mortgage Bankers Association, MBA, data from Q1 2024 indicates a significant drop in new mortgage applications and a rise in delinquencies, particularly in variable rate loans. Even Bitcoin, the supposed safe haven, is not immune to this protocol's early stages. While institutional adoption grows, it also allows for greater leverage and thus greater liquidation potential. Large institutional players are accumulating at strategic levels, but they also have the capacity to drive price downwards through massive sell orders or liquidating over-leveraged positions. The current stability above $60,000 is a mirage, a period of consolidation before the final brutal shakeout. The patterns of derivatives markets signal immense pressure building. We are entering stage 7 of this protocol, the final capitulation. The moment where retail investors, battered by inflation and job insecurity, are forced to sell their most volatile assets. This is when the trap springs. The $12,000 Bitcoin target is not arbitrary. It represents a critical confluence of historical support levels, mining profitability thresholds, and psychological breaking points. When Bitcoin approaches this level, the fear will be absolute. Media headlines will scream, "Crypto is dead." Mainstream financial commentators will declare Bitcoin a failed experiment. This orchestrated narrative will create maximum panic, forcing the last holdouts to liquidate their positions at the bottom. This is the moment the elite have been waiting for. The timeline for this event is likely late 2025 into early 2026. As global liquidity continues to contract and recessionary pressures mount, the squeeze will intensify. This is not a bug in the system, it is a feature. The elite wealth transfer protocol thrives on such engineered chaos. They will accumulate Bitcoin at fire sale prices, just as they did with stocks in 1929. Real estate in 2008, and sovereign bonds in every crisis before. Then, when the dust settles, they will reignite the engines of inflation, driving asset prices back up, but only after they have secured their positions. So, how do you survive this engineered collapse? The first step is awareness. Understand the game being played. Second, reduce your exposure to fiat currency and traditional banking systems. Diversify. Hold physical assets, but most importantly, embrace true scarcity. Bitcoin remains the ultimate scarce asset, but only if you control it. Self-custody is paramount. If it's not in your wallet, with your keys, it's not truly yours. When Bitcoin drops to $12,000, it will not be the end. It will be the opportunity for those who understand the protocol. It will be the final transfer before the next cycle begins. This is not fear-mongering. It's a historical warning. The elite's liquidation protocol is not a conspiracy theory. It is a recurring economic reality. Prepare now. Understand the trap. And when the panic peaks, remember, the greatest opportunities are born from engineered crises.